Hello everyone, welcome to today's US Open live webinar. It is Tuesday, December the 12th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. A central bank bleeds dominates this week as the US Fed announces its policy decision on Wednesday, followed by its UK and EU counterparts on Thursday. The big three are widely expected to stand pat again, but communication and updated projections from two of them will be closely watched amidst our market optimism for pivots. Today, less than an hour ago, we got the CPI inflation update from the US, which showed persistence. And earlier in the day, we had UK wage growth showing a moderation, but remaining close to historic highs. These are the things we'll be talking about today, but before we begin, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers. We'll give you a few more seconds to do that, and then we will begin. Okay, let's get the ball rolling. We have quite a few things to cover. We're gonna shake up things a little bit today, as we're gonna start by covering today's US inflation report, and then we're gonna talk about the upcoming decisions by the Fed, the European Central Bank, and the Bank of England, and then we're gonna also talk about Euro USD, GBP USD, and the Nasdaq. So as we have Euro USD on our screens, let's start with the Fed, and then we'll go into the technicals. The US Central Bank has refrained from hiking over the last two meetings, and as inflation is coming down and has become less aggressive, and in the last meeting it spoke of more two-sided risks between over-tightening and doing too little. Given the lag in the transmission mechanism, the Fed may have already done enough to control inflation, but markets believe that the terminal rate has been reached, and in fact, they expect 100 to 125 basis points of cuts next year, starting in March or May. On the other hand, inflation remains well above the 2% target, and today's data showed persistence as because what we got was the CPI, the consumer price index, staying at 4% year over year in November, and headline eased only marginally to 3.1% year over year, mostly due to a steep fall in energy prices. More to it, both measures accelerated on a monthly basis. The US dollar was volatile after the release with two-way action, while Wall Street faces some headwinds, but not really intense, and it seems that there is a high bar for markets to be dissuaded from this pricing this aggressive pricing, this hawkish pricing that we just talked about. Now, as we said, however, there was persistent inflation in this release today. Furthermore, the labor market is tight, as also showed by Friday's NFP's report, and the economy performed very well. The Fed has generally called for prolonged restrictive stance and has not ruled out further hikes. It is widely expected to stand pat on Wednesday, but market expectations for a pivot are high, so there's definitely room for disappointment. I think it will be hard for the Fed to stray away from this stance, this higher for longer narrative, or at least this prolonged restrictive stance narrative, given today's CPI report. New projections are also due, and this will be closely watched for the official's view on the appropriate policy path. The previous projections show a terminal rate of 5.6%, so a bit higher than the current, which is 5.5%, and 5.1% for 2024, which would account for roughly 50 basis points of cuts. Again, there is a huge disagreement right now between the Fed and the markets. Now, on to the ECB. It paused its tightening cycle, the European Central Bank, in October after 10 consecutive hikes worth 450 basis points, as inflation has made fast progress recently. Preliminary data showed that headline CPI rose by just 2.4% year-over-year last month, which was the slowest pace in more than 2 years. At the same time, the economy is in a poor state, and the bloc's economic engine is widely projected to contract this year. That is Germany, of course. The ECB has hinted at peak rates, which is also what markets expect, but markets also viewed cuts as early as 2024. This does seem like a stretch, although the ECB seems better positioned than the Fed for such an outcome. The Fed and the Bank of England, of course. And now turning to the Bank of England, officials there have kept rates at 5.25% for the past 2 meetings after 14 straight hikes. They were held with a substantial deceleration in inflation, and they are also concerned about the weak economy and risks for a borrowing crisis. There are good reasons as such for the BOE to stay on the sidelines, which looks like the most likely outcome for this meeting. However, at 4.6% year-over-year, inflation is far from the 2% target, and officials don't expect a drop below it for another 2 years. Wage growth has slowed according to today's data, but historically high, feeding a wage price spiral, and the government will increase minimum wage next year. So that does create upward risks. More hikes cannot be ruled out, and Governor Bailey has warned of such possibility while dismissing rate cut calls. And now let's head to the technicals. Of course, any technical, and the technicals now are in the background given these hugely important decisions coming up. But in any case, Euro-USD has breached the crucial 200-period EMA and the 38% Fibonacci of the recent rebound, creating risk for further drop into the cloud, but the daily Ichimoku cloud, but strong catalysts would be needed for the 2023 lows to be questioned, and these are located at 1.0447. The common currency tries to contain the fall, however, as we can see after the breach, and another push towards 1.100 would not be surprising, but the current policy dynamics are unfavorable based on what we discussed. As we said, there is a stronger case for the ECB to pivot than the Fed, or at least to do it earlier, but expectations around both seem overly optimistic at this stage, especially for the Fed. Now on to GBP USD. It faces some pressure after the UK wage growth slowdown and the US CPI release. It is in a similar technical crossroad with what we talked about the euro versus the dollar, and it is in risk of breaching the 200-period EMA, the black line on the chart, and failing into the cloud as well. Above the 200-period EMA, however, the British pound is on the driver's seat and can push for higher highs. The Bank of England has more work to do to restore price stability compared to its US counterpart, and that could be supportive for the pair. And now let's turn to the NASDAQ 100, the tech-heavy index. It runs its 7th straight profitable week, setting 2023 highs and coming closer to the all-time ones at 16,770, and that is of course because of high hopes by markets for a Fed pivot, for starting to cut rates even as early as March. The next leg of the move, however, will depend on the Fed's Wednesday decision, and as we said, there's definitely a room for disappointment there. It is contained today by the inflation print, and this creates risk for sub 16K moves, although stronger catalyst would be required for a breach of the 200-period EMA at around 15,680. Which could endanger the bullish momentum. Again, we need to stress that given the high impact events, the technicals are on the background, and any projection would be stretched at this time. So that's it from me for today. We will talk again on Thursday at the usual time slot with the outcome of those central bank decisions.